art classes or lunch and learn talks on latest technologies, there's always something new to find and help yourself grow. And I really feel like that's one of the best things that any company can offer is growth and opportunity.
Hello, everyone, and welcome to Denver Startup Week. I'm Connor Swanson, Developer Track Chair and member of the Denver Startup Week Organizing Committee. Thank you for joining us for our first ever virtual Denver Startup Week. If 2020 has taught us anything, it's that we are more powerful when we come together as a community to share ideas and help make each other better. And here we are, virtually showing the world what Denver is made of. At Denver Startup Week, we strive to make all of our sessions a space where attendees can connect, learn, and grow, regardless of gender identity, gender expression, race, ability, sexual orientation, and the combination of those identities. There is something for everyone at DSW. Thank you for joining us, and thanks again to all of our sponsors, especially Quizlet, for making this track happen. With that said, I'm excited to introduce you to our panelists for this session, How Money Moves. Please welcome Tom, Wade, and Sarah. They'll take it from here.
Thanks so much, Connor. Thanks everybody for joining. I'm humbled and I'm a little more nervous than I expected, so bear with me. I'm Tom Carden. I'm an engineering manager at Square. I've been with the company around 8 years, which continues to surprise me. I've made that work for myself in a number of different roles, both hands-on and leadership. Reflecting recently, I get asked a lot, why stay that long at a company that was radically different when I joined? And I think it comes down to some of the topics we'll touch on here around the power and importance of money movement. We get paid when our customers get paid. That alignment is super rewarding. It keeps us honest. And it holds true across payments, which is Square's roots, but also across loans, which I worked on last year. And we're hoping it remains true as we open up our bank, which we got permission to do this year. Quick overview of the session today. I've invited Wade and Sarah to join me in a pretty open discussion. We've got a few scripted questions and things we've prepared. Saved quite a bit of time as well for questions from the audience. Denver Startup Week came up consistently. I moved to Denver around a year ago, and it came up consistently when I asked people I was meeting what events I should attend. And it was the one that people had the most enthusiasm about, the most nice things to say. It was often where people had got a start in their career or got inspired to start something. So I'm delighted to be part of that. And when we talked to Connor about what could work, I think a fintech panel in general made sense. As we started our bank and I joined this team at Square late last year, everybody who joined my team asked, if we're a bank, where is the money exactly? And so as I've been building my network in the space and seeking out people like Wade and Sarah who are deeply well informed and can help answer those questions, I'm constantly surprised at the depth you can get to with a simple question like that. With that, I'd like the speakers to introduce themselves a little bit, and I would love to hear from them with who they are, what brings them to Denver Startup Week, and also a little bit about what they're hoping to get out of the panel. Wade, do you want to jump in first?
Sure. Hi, I'm Wade Arnold. I'm the founder of an open source project called Move.io, which allows for these low-level protocols and money movement to be out there on GitHub. And we think that it's an interesting way of democratizing the secrets of the US financial system to actually have it open and out there in public. Before I did this, I worked for a company called Bilgo up in Fort Collins, Colorado, which is about 150 people that does bill payments for top 20 banks and partners in the fintech space. And before that, I was at Jack Henry & Associates. I came there through the acquisition of a company I started, Banno, which was a digital banking platform. So I've been, I don't know how I ended up in banking. I was an engineer that accidentally became an entrepreneur that accidentally was an entrepreneur in financial services, which is now, I guess, a hot thing.
Nice. And Sarah, you want to go next?
Good morning. I started my career at a derivatives platform that built out their own fintech product and kind of helped on that end. We eventually ended up selling out to regional and community banks as both a platform and then kind of a white glove service where I was the derivatives desk / trader. I moved to, sorry, figures that my phone would ring as soon as that happens. And then I eventually moved out to Seattle where I ran our West Coast operation. Almost exactly a year ago, I moved to Denver to join a $5 billion commercial and retail bank here in Denver called Alpine Bank, and currently working in both the commercial and retail space for them.
Awesome. So I got a couple more opening remarks to sort of set the context for the questions, and then I'll turn it over to Wade and Sarah to talk through some of their perspectives. Like I mentioned, when Square got permission to open a bank from the FDIC, I suddenly realized what a powerful abstraction banking was. So we were asking the question, well, wait, where is the money really? I realized that when I have a bank account, all I care about is that the money is there. And it's like emotionally it's taken care of and the bank has done its job as long as it's there when I need it. Intellectually, when I sit down to build a bank account, when essentially I am the bank or Square is the bank, I know the money is held at the Federal Reserve. I know that much about US banking, and I sort of keep scratching the surface like, well, what does that mean exactly? Like when our customers have their money, where is that? And as you start to uncover how this works and how it's plumbed together, you learn that a bank has essentially one giant pool of money with the Federal Reserve, and the customers' balances are entirely the job of the bank. And so then I go, well, where are they? And I learn they're in a database, and I go, oh crap, a database. I know how those work. Oh, good, a database. I know how those work. And so there's kind of like uncovering these building blocks of what it means to put a bank together is where I ran into systems like Wade's. Move.io was among the only open source projects I could find that had any documentation of how this stuff is put together and how it works. And over the last few months, I've learned, there's 20 or 30 different vendors in the space that offer equivalent or similar building blocks to help you build a bank more quickly. And I've learned that fintech companies in general, the products that you get in the App Store, a lot of them are not banks, right? They're product companies that many of the people in the audience know how to put together. They're web apps that you can build yourself, but there's so many different layers and requirements to get right. As well as if you do lean on vendors or you lean on open source or you build these systems in a way that lets you concentrate on what you do best and build the product experience that you want, you end up running into a lot of distributed systems problems, a lot of things outside of your control and things like that. So that's some of what I've been learning over the last few months. With that, I'd like to take a kind of a step back and think about some of the big picture of how these products get put together. And I would love to start with asking Saira, like, it's clear why technology and product companies still need banks, I think, to partner with them to ship financial products. But it's less clear to me, and it's been less clear why more banks don't build technology-driven products themselves.
So I think that's such an interesting question, but I mean, typically you don't see people joining banks to work in technology. And truly one of the big problems that I've seen since the beginning of my career is somewhat of a brain drain, particularly after the financial crisis. So you see more and more people thinking working on Wall Street, trading, working in any sort of finance is less sexy after the recession hit. And really, from that point, you see banks really tightening their budgets after the financial crisis. And the biggest cut that I've seen has been within technology, which in my opinion was a poor choice. And in terms of investment, I actually think that is probably the one arena that most banks need to focus more on, particularly in the mid and regional size down to the community banks. It's the one pocket that I think they're truly lacking in addition to the large age gap in terms of human capital.
Cool. And Wade, what about your perspective? I know you've seen like the distribution of sort of budgets and things like that across banks very wildly. I think it's fair to say some banks do build technology, but many banks don't. Like, why is it that banks are not more technology driven themselves?
Yeah, I think if you look at the per capita spend on technology, you've got the top 4 banks are each spending $1 billion plus a year on their IT infrastructure and go-to-market strategies. So I just think it's disproportional, right? In the sense that, the power curve is very different between a $5 billion, regional institution, which a $500 million regional institution thinks that Saira and her team have unlimited resources, and that $50 billion institution feels like they have unlimited resources, and the 50 billion in assets is not even in the top 50 financial institutions in the United States. So I think it's just a order of magnitude issue, and typically the use of capital at the high end is how do I get to masses with self-service, and the distribution on the low end is how do I get involved in the best lending opportunities, the best small businesses, where can I put my capital to use that maybe the large institutions can't automate with technology, and address those with people. The trend of people being digital first, we'll see how that changes what banking looks like over the next decade.
Cool. I think it's obviously it's leaving opportunities for the scrappier startup companies to build products, but they still need to partner with banks, as we've described. What do banks look for in a technology partner? What is success like? Why are banks also interested in partnering with those companies rather than building in-house? Sorry, do you want to jump in?
Yeah, sure. Sorry, I wasn't sure if you're bouncing back to Wade first or not. The biggest thing that I always look for in terms of quality when you look at a fintech company that wants to partner with a bank is how they address fraud. And it's something that I don't necessarily think always gets put on the forefront in terms of fintech companies. But when you contemplate the intellectual property of a bank, really our IP is our customer information. So having that secured correctly, from what I've seen, hasn't always been at the forefront. That, in addition to a little KYC, AML, I really think those are from my perspective, the priorities that fintechs sometimes take a look at, but don't always focus on.
Right. And Wade, you've been on both sides of this as well. Like, what does a successful partnership look like? And I guess the flip side, like, where does it come unstuck? Where do people get it wrong when they partner with a bank?
Yeah, I think Saira mentioned this in the fraud space, but it's really defining that line of what either party does very well. Risk, compliance, underwriting, access to the financial system are all functions that banks do extremely well, right? So a bank is not going to have a fail fast and learn on their wall in the entryway, because if they fail fast, they lose lots of money very quickly. And yet that's kind of the go-to strategy of innovation in the Valley. So how do I fail fast quickly? You don't want to do that on a $100,000 transaction, and that your entire monetary benefit to just transfer that money is 5 cents. It takes a lot of 5 cents to catch up to a $100,000 loss. And so I think that nice balance between here's the things that we as a fintech are going to do well, and rely on that banking partner, and vice versa. What things can the fintech bring to differentiate the financial institution, yet where can we have that firewall between what either party does best?
Cool.
We continue to see in fintech saying, well, screw it, I'm going to be a bank. I'd put it back to you, Tom, that's a lot more than a technology company, right? So taking on that burden isn't hiring more engineers, it's hiring lawyers and regulatory compliance and auditors and comptrollers, right? Much different org structure than having more Scrum teams.
Very cool. I think, yeah, I'll sidestep the putting it back to me to avoid acting as a Square spokesperson, which I'm advised not to do. I do think we're only doing that on top of, you know, a track record now that's 10 plus years of building things with partnerships, and we're not stopping those partnerships anytime soon. So I think it's with great care. But yeah, good points. Want to dig into a little bit more with Saira specifically on her experience in this space, and talk a little bit about, you mentioned, Saira, your local work when we were chatting before the panel. We'd love to hear about both, like, you know, frankly, like how the pandemic has changed your work over the last few months, but also how technology has enabled you to keep going and things like that.
Yeah. So I'll start with the first part, which is your pandemic question. And we had to shut down all of our branches initially at the start of the pandemic, as I think many banks did. And we were appointment only, which aside from some of the terror that struck into our customers' hearts about their deposits, also created a multitude of new online issues for us. So suddenly every single community bank had to beef up their online presence, figure out mobile banking. We had to come up with some blanket changes to mobile deposits, that sort of thing. And then in addition to that, the PPP loan process, which I was fortunate or unfortunate enough to have a significant hand in at the bank, taught us about where we had holes within the bank as a whole, in addition to technology that we might need in terms of going forward on the loan forgiveness process. We also saw a lot of fintech companies stepping into that space. And one of the things from my perspective, when I saw that the PPP loan process and took a step back after both of the rounds had ended, the first thing that I saw was that a lot of fintech companies jumped into the space. Some of them were successful. I recently read about one or two that were not, and that faced a lot of fraud. And I think one of the ways that could have been prevented was with that human capital. And I think that that's kind of the significance of having a brick and mortar bank and having a relationship with someone. The biggest complaint that we received from new customers trying to come into our doors was that the bigger banks and the banks that focus more on the technology and less on the people, they weren't able to reach a single human being in this time of crisis. And I think the same thing actually happened back in 2008 and 2009 when I was sitting on our trade desk and dealing with people that were out of the money on millions of dollars in derivatives. So I think it's a persistent problem, and it's only one that comes up when the financial markets get turned upside down on their head. And I think it's important from both a bank perspective and a fintech company perspective to figure out what that balance is in terms of a partnership between the two.
Great. Yeah, you mentioned the importance of that physical branch presence and the relationships and things like that, and the sort of age of banking apps and the internet and things like that. It's interesting that the pandemic can spin that on its head. Yeah, how vital has the branch presence been for you when it's not clear if it's safe to go out into the outside world and things like that?
Sorry, did you ask a question in there, Tom?
Yeah, how vital has it been for you to have a physical branch presence? Yeah.
So this kind of touches on one of the things that you and I talked about, which was one of the projects that I was working on during the pandemic, which essentially what we did was we worked with a local nonprofit, an amazing nonprofit. I'm not sure if Amanda's listening or not, but the group is called the Village Exchange Center, and they're based over in Aurora, and they serve the unbanked immigrant population here in Colorado, which for what it's worth is significant. And what we did in partnership with them was create what's called the Left Behind Workers Fund. And these were people that pay taxes into our system, were laid off due to the pandemic, and were unable to receive any form of a CARES Act because they didn't have a bank account in any way, shape, or form. And what we did was, in partnership with Western Union and a wide array of other companies in terms of how we managed to vet them through VEC, get in contact with them, and then bring them into the branches to collect cash through Alpine Bank checks, or with Western Union, where they would then pay a fee to cash more anonymously than if they had come into the branch. But it was the first time that our branches became imperative, because there really was no way for the vast majority of them to receive any form of assistance, considering they weren't considered by the government to be part of the CARES Act. So that was probably the most significant project I've worked on in my career. We ended up impacting over 10,000 children, over 6,000 families, and we had raised, at the last time that I checked, a little over $5 million across the state of Colorado.
Awesome. I think it's that, that human connection, I think, is what keeps a lot of us in the finance and technology space ultimately. Let's see, I think I want to switch it back to Wade and dig in a little bit on the sort of bigger picture of what the banking system is, like how it is that we're moving that money. We talked a couple of weeks ago and again recently about just the scale of ACH, for example, as I think you were saying, is $56 trillion over 25 billion transactions, but it seems so antiquated. It's such a struggle to get money to move in a way where you have the kind of qualities you would expect from a technical system of instant movement or any kind of feedback and things like that. Why is ACH still so dominant? Why is it still used?
So I think ACH is dominant because it works, right? Number one, and it's cheap is really number two, and it's ubiquitous being number three. So any financial institution in the United States can send and receive money through the system in a very cost-effective and proven way. So if you kind of take the history of ACH started in 1970. An ACH file is 94 characters wide, because that's how many characters you could put on a punch card. It's a store and forward protocol. No news is good news, because literally people would get together with their checks and their ACH punch cards and exchange them in parking lots in the 70s and the 80s before the internet. And that's how the store and forward protocol really populated. And even today, ACH is done via SFTP, either to your financial institution or your financial institution to the Federal Reserve. Then the Federal Reserves clear on each other. And so that protocol, though, in order to move trillions and trillions of dollars a week, is at least sound, and there's a lot of law around it. And although it's a flat file format in a batch format, I guess it works, right? So, there's constantly this, well, how can blockchain fix this problem? Or how does XYZ company fix this problem? And, for billions of transactions and payroll and loan payments, I would say that the financial world says it's solved. And maybe there's new rails that need to emerge in order for new problems to be dealt with. Typically people ask me, why does it take 3 days for ACH to clear? It doesn't. It clears the next day or clears the same day. It's just, you have 3 days to argue that you sent that money, and there's no protocol to communicate that. And so the bank just holds that money waiting for you to not argue it for 3 days before it's released to you. And so it's really about this system that was designed before the internet, and not necessarily designed to be used in a real-time world, right? It was a better version of writing a check, and still that's a very relevant use case out there.
Right. Apologies to folks, I missed a couple of questions came in. And actually, some of them are relevant because well, I'm sure they're all relevant, but some of them's relevant to what Wade was just saying, in the sense that like these systems, some of the delays and things that are built in are there to allow for sort of error handling, right? And not in the technical sense we would usually expect, but if something has gone wrong, if something exceptional or something's being disputed, there's a delay built in. There was a question here around would automation around KYC, which is Know Your Customer, AML, which is Anti-Money Laundering, and BSA, which is Bank Secrecy Act, would automation around these be valuable to financials, especially in a high-risk transaction space?
Yeah, so actually shout out to Laura if you're listening. There's a really cool startup that surrounds that called Alloy. That's the one that I know of, have heard of, and know is gaining some traction. But absolutely, I think KYC, AML, BSA, they're all extremely important to us. And our biggest problem is that for example, when I first joined the bank, I had 19 different applications that I needed to use, and there are individual ones for KYC and AML and BSA. And I know that's something Wade is working to improve and compact for those of us in the banking world, but it's currently quite the process to figure all that stuff out. So I think that's a very, very significant and relevant solution that we're all looking for.
Yeah, I think that it's not duplication, right? It's proliferation of tools, because there's so many different screens you have to apply, so many different regulations you have to adhere to. Wade, I think this leads into one of the questions I wanted to ask you. Like, what are the technology problems every fintech startup has to solve? You've mentioned before these things that you've solved several times over now and never want to solve again, and you want to solve them once and for all as open source offerings. Like, how do you see that sort of laid out to address some of those automation opportunities?
Yeah, I think in financial services, as Saira said, the happy path is pretty easy, right? No, there's not a lot of complaints if you randomly get money in financial services. It's the exception path, I think, is the non-happy path is 90% of the workflow, 90% of the effort when you're building fintech products. And so I continually am advising fintechs is really around that exception cause, the reconciliation side, if somebody wants to send $1 million ACH or wire, they have good funds for it. Do you send it? Right? It should go out. They asked to do it, but are you going to allow that to happen? And I think the anomaly detection, right, that people are laying machine learning on and rules engines, all those things are great, but ultimately banking comes down to risk. And so we continue to see in fintech space where I'll deal with that problem when I get to some scale. I'll deal with that problem when it becomes a problem. But when fraud and other compliance issues arise, they usually aren't small problems. They're usually devastating to the fintech. And most fintechs don't have the luxury of losing $100,000 or $800,000 in a day. And that's how quickly fraud can come and be a part of it. And so that's where I think the innovation is always great in fintech, but the realization that these other pieces of the puzzle are critically important, is the types of fintechs that are successful.
Right. I'm seeing a couple of questions come in via chat. There is also a Q&A function in the Zoom webinar, which I would love for people to use, because that lets us queue up the questions clearly and then leave the chat for remarks to the side. I'll take one more question in the chat, and then I'd love for folks to use Q&A going forward. There's a question from Reed around if blockchain is already implemented in the fintech industry, and if not, how will it change the banking industry? I know that Square has a big presence in Bitcoin. I'm personally not involved in that, so I don't have too much to say about this one. I don't know if Saira, you have anything to say about blockchain here?
I know from a banking perspective, I'm trying to remember her name. She just made a speech about how the European Union needs to make their own digital currency, and I'm drawing a blank. Was it Christine Lagarde that she made that speech either yesterday or the day before, stating that the European Union will be creating their own digital currency. So I do think that there's going to be a shift to it from a national perspective. And then obviously all the big banks already have pretty heavy hands in terms of either creating their own crypto or something like it. In terms of the smaller banks, I don't know how we would create our own cryptocurrency. We barely have 3 IT guys in the back making sure my computer's functioning. So I don't know that you're going to see that in the regional and community bank space, but that's not to say that from a treasury perspective, there wouldn't be some investment in it in the future. Not saying that I have heard that rumor anywhere, but I anticipate eventually that it'll become similar to other treasury securities where you're adding it to your balance sheet in order to manage risk.
Right. And Wade, I don't think we ever talked about blockchain. I'm curious on your thoughts.
Yeah, I think that, the United States really above almost any other country enjoys monetary policy and the ability to be in the middle of that flow. So in the United States, if you separate monetary policy from technology, I see some of the stable coins, whether that's Libra Association or others that are based on the US dollar, those becoming really, really practical technologies for real-time settlement and balance inquiry, especially across different fintechs, right? You'd love to see my balance in Square Cash be able to instantly pay for my Uber or DoorDash, or you can see that stable coin side really being a great real-time infrastructure. Outside of that, if we look at Bitcoin, right, where it's its own reserve system on top of it based on mining, the speculation inside of that space, I think, makes it really hard for it to be a good currency for trading value inside of the United States. And then you also have the on-ramp and the off-ramp problem of fiat to a cryptocurrency back to fiat so that you can buy toys for your kids at Target. That ultimately is super useful. And so I'd kind of categorize those in two different places, and that, the true crypto exchanges that are based on mining, seem to proliferate in unregulated countries outside of the United States. Inside of the United States, I think we're going to see hopefully some consolidation around a stable coin.
Cool. I think whoever solves that still needs to solve that background layer of technologies we talked about, and regulatory and compliance requirements, know your customers, all of that stuff, potentially internationally, which is the hugest challenge.
Right. The internet's beauty is that you're anonymous. People don't really like you to be anonymous when it comes to monetary policy.
And I just want to clarify what I said earlier. So Christine Lagarde's the head of the European Central Bank, and she announced that they're researching and planning to put out a digital currency, and it was a result of the pandemic.
Right. I think a good follow-up to this one is a question from Tyler, which is, what do you think the biggest hurdle to financial institutions adopting new tech? Is it regulations? Is it cost? Is it something else? I can't leave it to either of you to jump in on that one.
So to me, I think the biggest hurdle is vendor management, right? So the FFIC sets out regulations for what a vendor needs to do in order to be solvent, perform well, properly safeguard personal identifiable information. And so that moat in financial services is real in order to make sure that you can have a sound business that can service the financial institution. So that's kind of moat number one. That's just being in the industry. Moat number two is, how do you connect to some of these systems, right? To Saira's point earlier, when I have 28 different screens to do 28 different tasks, the tolerance to add one more screen that's a big hurdle to overcome. So now all of a sudden you need to integrate into their existing application, their existing infrastructure, so you're not continuing the proliferation of yet another admin screen or yet another identity to log in order to complete the day's tasks.
I would love more questions from the audience. Those of you who are able to ask questions in the Q&A in Zoom, please feel free to do that. Digging back into some of the topics that we had talked about earlier, I think it's kind of related to, why don't banks build their own technology more often? I'm curious why banks aren't acquiring more fintech companies when there's when there's so many options in the space. Saira, I think we talked about this briefly over the weekend. Like, is it just the revenue multiples? Is it differences in how the businesses are valued? Or is it something else more fundamental?
So, I mean, I think like you mentioned, the first big problem is the valuation multiple, right? You're talking about a significant issue for a smaller bank to attempt to acquire because it would create undercapitalization on the bank's part, which I won't dive into, but that's obviously the kind of the overall umbrella reason why most banks would not acquire a fintech. But from my perspective, the other side of it is the business model fit, right? So banks have a very specific culture. There's a very specific way that we're structured. And then to acquire a fintech company on the side, there would be some significant hurdles to overcome. And I think the other big thing is that historically banks tend to drive partnerships. And I think by refining those partnerships, it's easier and cheaper on our side to do that rather than to look at an acquisition. So kind of going back to the last question that you had touched on, I think the biggest problem from a bank perspective would be that we have aging technology that's significantly outdated because the Jack Henrys of the world twist our arms and force us into 7 to 10 year contracts because they know that once we're locked in and we have some kind of a prepayment penalty, it's nearly impossible for us to shift to another technology without facing significant expenses, in addition to having to relearn an entirely new system. So.
Got it. The Jack Henrys of the world are still pretty alien to me as a newcomer to the fintech space. I know, Wade, you've integrated with more of those than most people have. Like, what are those systems doing inside of the banks, and why are they a challenge then for people to innovate on top of them, aside from the timeline issues and things like that Saira already touched on?
I think one of the larger issues is just like this impedance mismatch of technology. So if you so I would say, you know, the FIS, Fiserv, Jack Henrys of the world do an exceptional job for branch banking, brick and mortar banking, right? So if you wanted to start a bank and be compliant and go to market, and your customer acquisition strategy was being on the corner of First and Main, you know, they do a really great job. The underpinning technologies of those systems, though, are, you know, RPG code written on an AS400 or an S390 in COBOL, and so you have, you know, maybe you know, somebody like Chime has a single DDA account, right? A single account type. On one of the branch banking cores, you know, they've had 1,000 or 10,000 different checking account types that are all different feature flags in order to make those work, or 10,000 different loan types. You know, in the case of where we're at up in the mountains here, maybe you want to do a commercial loan that is interest only in the shoulder seasons, and it's dual principal payments during the ski season, right? You can build those type of loan products on top of these systems, which are why, you know, the community banks are able to serve those customers. All that being said, all of that's really good. But how do I, you know, connect my AWS Lambda functions to the S390, right, in the basement of the bank? And I think that's the impedance mismatch where there's that constant, hey, I want to keep on doing what I'm doing that has the majority of my deposits, has the majority of my loans, but I want to be innovative as well. How do I do both? And that innovation, my unit cost economics needs to be super cheap. It needs to be in the cloud. I want an account for 10 cents, not $10 a year. And that's, I think, where some of the frustration in innovation in financial services comes from. Is I still want to keep on doing everything I'm doing. I'm not going to shut down all my branches and go all money, lion, coin, you know, digital bank, right? Because my bank would go out of business. But how do I do both? And I think that impedance mismatch is kind of the current frustration in banking and fintech as well.
And just to kind of add to that, I think retail banking is very important, but from a commercial banking side, there just is no innovation in terms of assistance with the sales process, assistance with, what I call a loan committee packet. So the streamlining from underwriting all the way through approval, all the way through documentation, it's not streamlined. Off the top of my head, I can think of 5 different apps that would be required to be used in order to get through that process alone. In addition to the fact that we also have a pricing mechanism that I personally think is extremely faulty and could use significant updating. And there just aren't that many options in terms of pricing to begin with. So those are all on the commercial banking side versus just on the deposits.
We've got several questions rolling in. Looking at, there's a couple of these around the sort of technology and Move in particular for Wade, and then there's a couple for you, Saira, as well. I don't know if you both want to sort of skim those, and then maybe we could jump in with Wade first on the Move one.
Okay.
Is there somewhere we can see the question?
I think so. I don't
Got
know
it.
if you don't have the Q&A view turned on. It's one of the buttons on the bottom on my screen. Hopefully you have it too. So yeah, Wade, there's the one there around payment processing, especially for risky payments and logistics.
Okay. So I see one from Aaron. Should I answer that one first?
Yeah, there's the one from Aaron and then the one from Vince, I think. Yeah.
Okay.
So
rules engines like from JBoss and there's a lot of rules-based engines kind of in the enterprise software space. Kind of that combination of rules engines and workflow engines. So BPM 2.0 and other tools are super prevalent inside of financial institutions. So I want this, minimum or maximum or velocity rate. Those are really the explicit rules that you can put on top of transactions. And then, outside of those transactions, let's kick it off into a different queue, right? Let's utilize something that maybe goes to a workflow engine, maybe utilizes machine learning in order to say, this is outside of my bounds. Now I want to make additional decisioning on top of this. Probably where machine learning is happening the most is fraudsters are very smart. They figure out very quickly that your top line limit is 5,000 or 10,000 or 15,000. And turns out that $9,999.99 is almost as good as $10,000. So if you can get that money out, feel free to, game the system to get that money out. And that's where we're seeing, a lot more of machine learning, frankly, just statistics as well, not to get overly fancy, inside of the fraud and automation space. So that's that one.
Yeah, I think just adding on to that, some of the things I've seen around rules engines. I know in Europe, there's now regulation in some countries around the application of algorithms to eligibility for loans and things like that. And a rules engine as a piece of technology that is a lot more, I guess it's not inscrutable, right? You can take it apart and you can talk about exactly why it came to a conclusion that it did. And I think you're right to call out like the difference between machine learning and statistics. I think somebody can point to a statistical model. More often than not, they can describe why the output was what it was. Some of the more sort of black box machine learning models that people apply, or AI in big scare quotes, it doesn't actually stand up to scrutiny, and you can't describe why you declined somebody's loan application or why you weren't willing to underwrite something, right? So yeah, that's something else I've seen in rules engines in general. It's like the ability to explain yourself is actually super valuable.
Yeah, and they can work negatively too, right? I've got a friend that is in charge of payments at a top 4 bank, and it turns out machine learning stops payments if everybody gets a $1,500 check to 60 million people. And they didn't have a great way of taking them out of that caught queue. They literally clicked a button 60 million times in order to release those out of that workflow engine as the stimulus checks came through. So it was an amount they had never seen before, from a payee they had never seen before, on a day they had never seen before. This is a great use case for machine learning to stop a payment, except if it's 60 million payments to all of your consumers that need a stimulus check. So it's interesting how these tools you don't have a lot of strength, and you also have to always think about the non-happy path and how they work.
Right. Sarah, there was one directed at you. How have your clients reacted to increased need to integrate technology into their banking lives? And do a lot of your clients push back on using tech instead of using in-person banking?
Sure. So it's a great question. And the nice thing is that most banks had a mobile form of doing everything already. So to be perfectly frank, branches are somewhat of dinosaurs, and they exist in the community banking world so that we can claim footprint, right? So it's so that we're able to say that we're permitted to lend in specific areas, and we give accessibility to the people in our neighborhood by having them. Generally speaking, the average age of a person that walks into a branch is over the age of 50 for a fun statistic about branches. That being said, did I get pushback? I wouldn't say that it was a ton of pushback as much as learning the nuances of how to do an overnight FedEx to get documents out for remote closings, and understanding I suddenly needed to memorize exactly how many days I had to get certain things done in order to push paperwork back and forth correctly, because some things still need to be signed in order to get large commercial transactions closed. Aside from that, there were a lot of large mobile deposit requests that came through our electronic banking, which was, it was just kind of accepted that we were taking on greater risk with our online banking. But I haven't struggled a ton outside of that. And in terms of recommending clients that need to adapt to the online banking easier, the easiest thing to do is probably to call your help desk for whatever bank you belong to, because there are always specialists present that can step you through the entire online banking process. And hopefully that whatever bank you belong to has easy access in doing that. But I mean, that being said, our bank kind of stands by the position, which is one of the reasons that I'm in here right now, that banking is still partially, at least, an in-person process, particularly for certain types of customers. So, I don't think branches are going away anytime soon, at least not here.
Looking at the other questions that are coming in, there's one person celebrating community banks who says community banks, yeah. There's another one here around local banks from Ben, saying local banks have traditionally been able to provide cheaper loans than national banks, but it seems many startups are targeting that space. Loan aggregation sites don't feature local banks. Are local banks giving up on that space?
So in terms of what we do in marketing, our target is not to find, community banks in general, is they don't tend to try to find customers through blanket marketing, right? So I'm not going to go pay a bunch of money to have Alpine Bank at the top of a Google search, because we are essentially a word of mouth bank. We are built on relationship. The vast majority of our customers that come through our doors have heard something positive about us, which is why they're inside of our branches or online, whatever the case may be. But in terms of marketing, that's not where our investment's going to lie, because generally speaking, people within our community have already heard of us and will switch to us because they've heard something positive, not necessarily because of online marketing. So that would be my response there.
Cool. There's no more obvious questions in the Q&A. I have a couple more topics I think we could come back to. I think there was one more question in the chat. Looks like Wade, you were busy answering that one in the chat. Great. A couple of the questions, if we sort of zoom out from the discussion, I think like it's clear so far, like the human element is key, physical presence is key. A lot of the fundamentals of US banking aren't broken, I think is the assertion from Wade. Like they solved a set of problems really well back then. But we've talked about the dynamic of how banks aren't necessarily incentivized to go innovate in these spaces. And there is then an opening for fintech companies to go explore different solutions and solve different problems that people have. What are the most interesting and exciting fintech products that you're seeing out there? And based on your experience, what challenges might they have, and how might they solve them? Saira, you want to jump in on this one?
Sure. Are we talking Denver specific or just in general, Tom?
I would love it if it was Denver specific, but it could be wider as well.
Sure. So I guess one of the things that I've really loved watching is the growth of blockchain here in Denver. I think that technology is immense. I don't know anything that's growing that quickly. So I actually love that is a significant portion of our fintech population here. That being said, there are a couple of different technologies that I like. I've only heard about these. I haven't actually worked in them specifically or done anything with them, but Maxwell, which I believe is a mortgage platform, and then Personal Capital, which is a wealth management. I think RoboAdvising is a really neat niche that I'm watching grow here as well. And then mortgages, obviously, I find fascinating, and I'm hoping at some point we can completely automate those at every bank.
Cool. Wade, anything you're watching closely or with excitement?
Yeah, I think the combination of card acceptance and availability of balance in platforms and marketplaces, to me, is the most exciting thing. So you take a Uber driver who accepts money for that transaction and can 1 minute later fill up the gas tank, with the money that was just received, and not having these days of settlement across the system. I think that's where we're going to see a lot of innovation, a lot of quicker access to capital, is as these historically independent systems, credit cards over here, debit cards over here, merchant acceptance over here, lending, the innovation of these cross-functional disciplines starting to come together is really exciting for me.
And with instant money movement, obviously the risk models are totally different to with ACH, where we've talked about those potentially days before those funds are truly available. Like where's it going to come unstuck? What challenges are people going to face as they scale out instant money movement products?
Yeah, back to Saira's comment at the very beginning, real-time money movement now requires real-time risk. And so if everything is batch, and batch can be everything from batch processing on the technology side, but it's also batch processing on a loan committee side, right? We only meet on Monday afternoon in order to get this loan approved, or we only meet once a month to get these commercial loans approved, right? That's still very common. That decision making versus somebody like a firm where you can click a button and walk out of Best Buy with a product. There's a big difference, a big discrepancy between those two lending modalities, and so it's going to be interesting. As financial institutions say, well, I don't care about financing the dishwasher or the TV. As that goes up market, I bet they all start caring a little bit more.
Saira, there's a follow-up question on robo-advising. Can you expand on how you think new fintech could impact or change that space?
Sure. So actually, there's a lot of really interesting companies in that space right now in terms of different robo-advisors that you can find online. Is it Betterment, Wealthfront, the one that I mentioned, Personal Capital. And then I've recently discovered that there's a bunch of people also disrupting in terms of like a hedge fund. So if you're looking to do investment in a hedge fund style process, I recently started toying with Titan. I know that there are 2 or 3 others in that space as well. So in terms of robo-advising, you have a large swath of people that have started to disrupt that space, which I think is honestly excellent, because from what I've seen, it's a little bit more clear as to what fees you're going to end up paying, and it's a lot more streamlined. I love the fact that I have a quick app that I can now go into rather than having to go through the pains of dealing with a financial advisor.
Wade, I don't know if you have anything to add on that one.
I don't.
Me neither. We are running up to time. We're all done with questions that came in. I don't know if either of you have closing thoughts you would like to add, or anything else to promote. You can let people know where to find you online or anything else like that.
Well, I'm constantly on Twitter. I'm the chief Twitter officer, CTO of Move Financial, at Wade Arnold, and I'd love to connect with anybody who's interested in open finance and building on top of open standards.
Right.
And I'll also say the same. I am continuously on Twitter, although I do enjoy the good shit post in addition to talking about finance and technology. So, and it's just my name, Saira Rahman.
I think I'm the only one who doesn't use my name as my Twitter handle. I'm also on Twitter and enjoy a good shit post. And also I'm learning a ton from folks like Wade and Saira in the FinTech community. So if you're watching a recording of this, I'd love to hear from you if you have questions that you wish you could have asked us in person. And otherwise wanted to thank both Saira and Wade for joining me, and thank everybody who asked questions and contributed to the chat. It is an eerie thing to be presenting remotely with no audience feedback. So I really super appreciate the chats and Q&A. And yeah, hope to connect with folks online afterwards, and hope to catch some of you in the more social aspects of Denver Startup Week in the next couple of days. Thanks so much for joining us.